Corporate finance practice problem using Excel. Financing using common stock problem 2. Get ready. It's time to take your chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet and would like to follow along, note that we are in the practice tab as opposed to the example tab. The example tab in essence being the answer key. Information on the left-hand side, populating that information into the blue area on the right-hand side. We are now looking into the equity financing as opposed to the debt financing here. Now looking at the common stock issuance for the equity financing as opposed to the preferred stock. The common stock, probably the most common thing we would think of with equity financing. Remember, we're talking about or thinking of the issuance of the stock from the organization. When stocks trade on the exchange, usually it's being traded amongst stocks that have been already issued. We're talking about here the company issuing the stock, the money then going to the organization in order to finance the operations. When stock is issued, we then have value that's going out. They have the owner or an ownership interest is basically thought of to be being sold. So in essence, we can think about the cost as basically kind of the net value of the organization from a bookkeeping standpoint, assets minus liabilities, or basically the retained earnings. We can think about that from the standpoint of dividends that will be paid in the future or commitments to dividends. And we can also try to think about that in terms of the estimated growth in the value of the organization that is now, a piece of it being owned now when we issue the equity interest. Okay, so let's go through our calculation here. We're going to do this 2 different ways. We're going to add then the flotation costs in the second one, and we'll call that the cost of common stock versus the cost of retained earnings. Retained earnings, as you know, the accounting equation would be, if you take assets minus liabilities, you got the retained earnings, which you can think of kind of like the value of the organization in that format. So when we issue common stock to owners, they own the company and therefore they have a claim to what you would think about as kind of like the equity section of the organization. So that's one way to kind of mull it over. So we'll have the dividends. Let's calculate the dividends here. We're going to estimate that the dividends are going to be paid per share. That could go basically indefinitely because the dividends will be paid out. There's no maturity date per se. I'm going to put that in the inner column here. It's going to be the $4, and we're going to then take the common stock price. This is what we're going to receive, the $90 per share issued, because that's what we can sell it for on the market. Font group, underline, and then we've got the subtotal. I'm just going to call it subtotal. It's the total below the calculation, which is going to be the $4 divided by the 90. Subtotal being if we add the percent numbers group, percentify, add a couple decimals. I'm going to indent then the subtotal, alignment group indent 4.44. Now then we're going to add to that. We could think about that. It's kind of like the cash flow situation of it. But then we also have the value of the common stock, which I'm going to add to it as well. So that's going to be the growth of the stock, because that's also something that is basically in the cost here. And that's going to be, then we're going to say it's growing by 6%. That, of course, would have to be estimated to some degree. We have the numbers group. We've got the percent. We're going to underline in the font group and underline. That'll give us a total we're going to call cost of retained earnings and we're going to just add these two up, the 4.44 plus the 6, adding or making that a percent numbers group percent, and then add a couple decimals. We're looking 10.44 about. Here's the calculation for it down below. Cost of retained earnings equaling the dividends divided by the common stock price. Remember, you do this first, and then add the growth rate. Now, if we add on the flotation costs, we're going to call that the cost of common stock, basically the same thing. But now we're going to take into consideration the fact that in order to issue the $90 price, it's going to cost us, we're going to say $3 basically in just one-time fees to get it done, to get that done. So now we'll add one level of complication calculation looking like this. Common stock, or the cost of the common stock, basically kind of same thing here, except we're just taking into consideration that one added one-time cost, which is the dividends divided by the common stock price minus the flotation cost, which you can think of as like the net sales price for the stock, plus the growth rate. So same kind of thing, one more sub-calculation. Let's take a look at it and say, well, what if the dividends are still the $4? I'm going to put that into our middle column here. Middle column. Then I'm going to count the net price. We're looking for the net price now. So I'm going to say net price, colon, And that's going to be the common stock price, which I'm going to say is equal to the $90 minus what it costs for us to issue it, which we're going to call the flotation costs. Because I'm not sure why they call them flotation costs, to be honest. They're floating costs. But those are the one-time fees and whatnot to float the stocks out into the marketplace where they can be grabbed for $90. So we're going to then say, let's go to the font group and underline and subtract those out. And that's going to give us the net price. So the net price then equaling the 90 minus the 3. So now we're going to get the 87 after that one-time floating cost. And then we're going to go to the font group and underline that. And let's do some indentations here. Go into the alignment, indent, net price. Let's indent, alignment, indent that again. Looks way nicer that way. Then subtotal. Subtotal, we're then going to say this is going to be equal to the 4 divided by the 87. Let's go ahead and add percentify, number group, percent, couple decimals. We're looking about 4.6%. Then we got to add the growth to that. Growth needs to be added. So now we're just going to add the growth again. At this point, we're right to basically the same kind of area we did up top. The only difference in that now we have that subtotal after the one-time cost. So then we're going to add the growth, which is going to be the 6%, making that a percent, number group, percentifying it. Let's underline it, font group, and underline. That's going to give us our cost of common stock. I'm going to use the trusty sum function to add them up this time. Trusty sum of those two, adding those two numbers up, making it a percent, number group, percentify, couple decimals. We got the 10.6%. Let's do it again. New set of problems. We're going to do this a few times, so I'll go through it a bit more quickly here. Retained earnings. We got the dividends per share of the 1.2 this time. So that's how much it's going to cost us on an annual basis. Common stock price is 51. So when we issue the shares, we're getting $51 per share. That's the market price. That's what we can get for them. We're going to get whatever we can. We are issuing them onto the market here. The expected growth rate is going to be the 11%. So that's also part of the value that will be given. Flotation costs $4. So let's calculate this, which we'll call the cost of retained earnings, basically the cost before considering the flotation cost here. So we're going to say, all right, then the dividends are going to be here, and we'll calculate the dividends at the 1.2 on the dividends. And let's add a decimal so we can see the 20 cents numbers group. There's the 20 cents right there. And then we're going to go to the common stock price, comparing that then to the common stock price. So it's going to cost us $1.26 to get the $51 per share. Underlining that, font group and underline, that's going to give us our subtotal. And that's going to be equal to the 1.2, $1.20 divided by the 51 sales price, making that into a percent, number group, percentify, adding a couple decimals for it. Let's go ahead and indent the subtotal. Then we're simply going to tack on to that, adding on the expected growth rate, because that's what we're giving up to. Because we're giving up basically, you can think of it as a component of retained earnings, of assets minus liabilities, of the net assets, you can think of it. And those net assets we expect to grow by 11%. So 11%. So number group, percentifying the 11, underlining font group and underline. And that will then give us the cost of retained earnings. Sum function, trusty SUM of those two items will then percentify that. Number group, percentify, add a couple decimals. We're looking 13.35. Let's add the flotation costs and call it a whole new thing. Call it cost of common stock. Basically same thing here. But now adding the $4 for the flotation, meaning we're not really getting the 51. We have that one-time cost, 51 minus 4 is kind of what we're getting. So let's just add that into our calculation. So we'll say, all right, no problem. We got the dividends. Dividends, I'm going to put that into the middle column this time, making it a 3-column worksheet, more advanced 3-column worksheet. And then we're going to go to the numbers group and add a couple decimals. There's the 120. And then we're going to calculate the net price instead of just the price, because we got to add the nuance of the flotation costs, because they can be kind of expensive actually, those flotation costs. And that's going to be equal to the 51 And then we've got the flotation costs, which is the one-time cost of us issuing these things. It's going to be the $4. And let's underline that. We're going to say font group and then underline. That's going to give us our net price. So I'll call it the net price, because that's what it's called. And then I misspelled it up here, so I'm going to fix it. That might be bothering people. And then I'll subtract this out. 51 minus the 4. That's going to give us our 47 on the net price. Let's underline that. Font group underline. Now we're going to compare the dividends not to the price, but the net price. But before we do, let's do some indentation. Selecting these 3 cells, alignment, indent, and then the net price, and then indent that again. That looks way better. Then we have the subtotal, outer column this time, comparing the 120 dividends we're going to have to pay for the net price, the 75 that we're going to get after the flotation costs. And then let's add a percent there, number percent, couple decimals on that one. And then we have to add to that the expected growth rate, just like before, which is 11. So I'm going to say 11%. That's what I'm going to say. And then font group, percent, font, underline, and that's going to be the cost of common stock. A trusty sum function equals SUM of those two numbers, making them into a percent number group, percent, adding a couple decimals. We're looking 13.55. Let's do it again. So now the dividends are going to be annual dividends 2.10. The common stock price, we could sell these on the market for the 29, expected growth 9%, and then the flotation. So we'll calculate the cost of retained earnings, which we're going to say is the cost basically before the flotation cost. That's what we're going to call it. And we're going to say then the dividends this time, that's our annual cost, is going to be the 2.10. That's what we got to pay out. That's what we're thinking we're going to pay out. And we're going to compare that to what we're going to get, because we're going to sell these things per share, $29. $29. That's how much the market will pay us. So we're going to go to the font group and underline that. When we do that comparison, I'll call it a subtotal. The total below the other stuff, sub to the others. 2.10 divided by 29. Then this is going to be a percent number group, percent, add a couple decimals. Let's indent the subtotal, indenting that in the alignment group, and then tacking on or adding to it the expected growth as well. And that's going to be the 9%. 9%, number group, percentify, font group, underline. If we add those two up, equals the sum. We think the cost then is going to be, if we make that into a percent, 16, and then a couple decimals, 24, 16.24. That's going to be the cost of retained earnings. Now let's tack on the flotation costs and call it the cost of capital. So same kind of process. We're going to say, all right, we still have the dividends. No change there. No change there. Dividends are the dividends. That's the annual cost of the 2.10, which we're putting in the middle column now, because now I want to do a subcalculation, which is going to be called net price. Net price, colon, which will include the common stock price, and that's going to be equal to the $29. But then we got to pay $3 one-time fee to float these things. We don't want these things sinking, and if you want them to float and not sink, you got to play, that doesn't make it. A font group, underline, and this is going to be the net price. So the net price is going to be equal to the 29 minus the flotation one-time cost to get these things floated out there. 26, let's put an underline under the 26 font group, and then underline. Then we'll take the trusty subtotal. I need to add some pennies to this $2 because I can't see the 10 cents. So I'm going to add a couple decimals. So it's 210. This is the 210. There's a freeway here called it. Anyway, divided by 26. And then number group, percent, add a couple decimals. We're at the 8.08. And then we'll just tack on once again the expected growth. This time at the 9% on the expected growth. Adding that, making it into a percent, underlining it in the font group. That then is going to give us the cost of common stock. Sum function equals sum, SUM, of those two. and then number group percent, add a couple decimals like that, 17.08. Let's do some indentation here on these three. Let's indent those, make it look nicer. Alignment, indent. I think it's nicer. You might not need to. Maybe this doesn't look as nice. You know, it's just my opinion on the indentation. It's not a requirement, in other words. Let's do this again. Let's do it again. Can we? Yes, we can. We've got the dividends per share now $7, the common price 55, the growth at the 7%, and the flotation now 6%. All right, let's do it again. So we got the dividends, cost of retained earnings, not including the flotation, dividends, that's how much it's going to cost. It's annual. That's the $7 we've determined this time. And then the common stock price, that's how much we're going to get per share, 55. Underlining that, font group underline, and that's going to give us a subtotal equal to the 7 over or divided by the 55. Need to make that a percent so we can see what's going on. Number group percent. Let's add a couple decimals. We're looking 12.73. That's what we're looking at. That's what we're looking. And then this is going to equal the expected growth. Adding or tacking on plus expected growth 7%. Making that into a percent. Number group percentify. And then let's underline it while we're here. Font group and underline. And that's going to give us the cost of retained earnings equals the sum, trusty sum function of those two numbers. Then font group percentify, add a couple decimals. Now let's tack on the flotation costs. Same thing, but with flotation added, the one-time cost of us issuing these stocks. So we'll add that bit of complexity. We still have the dividends that we're going to be paying on an annual basis, looking 7%. We're looking 7% there. Then we're going to take the net price. This is the new thing that's happening. New thing right here. Common stock is going to be the 35. We saw that before. But then the really new part of the new thing is the flotation costs that are added. Flotation costs 6% or $6. That's how much it costs to float these things out into the market, apparently, so they don't sink. And that's going to give us the net price equaling the 55 minus the 6. Then let's underline that one, font group and underline, and that'll give us then our subtotal, and this will be equal to the 7 divided by the 49 now, the net kind of price, making that a percent. Number group percentify, adding a couple decimals. Let's go ahead and do some indentation over here too, selecting these three cells, alignment, indent, net price, indent. So much nicer, I think. I feel like that's worth doing. So then we have the expected growth, adding the expected growth to it too. That's going to be equal to the 7%. 7% added on, making that a percent. Number group percentify, and we don't need any decimals because it's just 7. And then font group and underline, and then we'll call this the cost of common stock, because that's what it is. We like to call things by what they actually are. That makes things easier for people to understand. So then we're going to say that this is going to be the number group percent and then a couple decimals. So we're looking 21.29%.